about to drop the hammer and dispense some indiscriminate justice.
Welcome back to Strongman Personal Finance, everybody. I am your favorite host, Christopher Bell, certified public accountant, long-term boglehead investor, author of the book Stop Being a Broke Loser, and hater of QQQ, a highly concentrated ETF that is going to have you selling your butt down at the truck stop in retirement. Now, in this video, we're going to compare the QQQ ETF, which is very popular, to the SPY, which is the S&P 500 ETF. QQQ is simply the largest 100 stocks on the Nasdaq exchange that are non-financial companies. So you're going to have Apple, Microsoft, Tesla, Facebook, all of those stocks are going to be captured in QQQ. You compare that to the S&P 500, that ETF has the 500 largest companies in the United States. So it's also going to have all the same stocks, or most of the same stocks in QQQ. The main difference is QQQ is highly concentrated, and we're going to go look at the holdings. It's highly concentrated in basically the top 5 stocks in the United States. I believe more than 50% of the portfolio is in like 5 or 6 stocks that have recently had a massive run-up and, in my opinion, are pretty overvalued. Now, if you have to choose between the two of these, you don't need both, because if you choose the SPY, for example, and then you try to add QQQ, you're buying the same companies. They basically have the same largest companies in their holdings. So what you're doing is you're just buying the same stocks and you're not really diversifying. So if you have both of these in your portfolio, you might want to reevaluate why you have both of them, because you're just buying the same stocks and just kind of like mishmashing the percentages in your portfolio, but you're not actually adding any diversification. Now let's look at some of the main differences. So these are both index ETFs. QQQ is on the left, the SPY, the S&P 500 is on the right. The QQQ tracks the Nasdaq 100. I just said that's the largest 100 non-financial stocks that trade on the Nasdaq exchange. It's a pretty narrow index because there's over 3,000 stocks that trade in the United States. The expense ratio is 0.2%. That's not horrible, but if you want total U.S. exposure, you can get that a lot cheaper than 0.2. So I'm personally not a fan of that expense ratio because it's pretty high for an index ETF, and you're very narrowly concentrated in just a few companies. Assets under management, that's important for liquidity reasons, $183 billion. So it's pretty liquid, basically. Compare that to the S&P 500, the expense ratio is half of QQQ. It has $382 billion of assets under management. That is even more liquid. That's almost double the size of QQQ. Now, let's go look at the holdings, and I'm going to show you it's basically the same thing, except QQQ just overweights certain large cap growth tech companies in the United States. So we go down and look at the top holding for each one. QQQ has 11.2% of its holdings in Apple, whereas the S&P 500 ETF, the SPY, has 6.08. Look at the next one, Microsoft for QQQ, almost 10%. And in the SPY, it's 5.77%. So if you notice, if you buy both of these ETFs, you're buying the same freaking companies. There's no diversification. You're just overweighting certain companies based on their market capitalization of the United States stock market. Now, in my opinion, even though QQQ has done extremely well over the last decade, you need to keep in mind that historically, different types of asset classes rotate. Sometimes growth does well, sometimes value does well, sometimes large cap does well, sometimes small cap does well. You can't just throw all your money in an asset class or a factor that has recently outperformed, much like QQQ has done, because what you're doing now is you're probably buying at what I like to call a high. So in my personal opinion, if you just want United States stock exposure, and you're juggling between QQQ and the SPY, I would much rather you invest in the SPY. You're going to be buying the same companies, but in the SPY, you're buying 400 additional companies, and you're not going to be super concentrated. I mean, QQQ basically has double the percentage double the weighting of the top 5 or 6 stocks that the SPY does. So if large cap tech gets freaking hammered sometime in the future, you're not overly exposed. That's basically it. There is no reason for you to take such a massive risk by solely concentrating your portfolio in 100 stocks in one country. If you're going to invest in the United States, you might as well buy as many companies as possible. I'm not even a fan of the SPY, but if you have to choose between the two of these, I would rather you do the SPY because you have a lot more diversification. Now, if you look at performance, this is what tricks people into buying QQQ over the SPY. Now, recently, the SPY has done better than QQQ. For the year to date, the SPY has returned 18.63%, and the QQQ has returned 17.09%. Now, over 3 years, you can see there's a massive difference. QQQ has returned 111%, while the SPY has returned 65%. Look at the PE ratios. Look how expensive the companies in the QQQ are. 32. That's basically almost a 3% return per year. That's basically your expected future return if you're buying QQQ at that price. Whereas you compare that to the SPY, the PE ratio is much, much less, 22, which is basically just under a 5% expected return. I would much rather diversify my holdings and buy companies that have much lower price to earnings ratio. A perfect example is what just happened to Amazon recently. Amazon missed their revenue expectations, and the freaking stock tanked like 7%. If you're in QQQ, you're going to feel a significant amount of pain because you're so highly concentrated. So if Apple gets hammered, Microsoft gets hammered, if any one of those top stocks get hammered, your portfolio is going to be hurting pretty bad. And God help you if all the large cap growth companies get hammered for whatever reason. There's a massive increase in interest rates, or revenue projections for all large cap US growth are much less, or they were overestimated. You need to be really careful. So just to summarize this, I would not have any money in the QQQ. You can buy the exact same stocks in the SPY, and you're not going to be massively overrating them. I don't care about historic performance. There's a reason there's a disclaimer on prospectuses and investments that says past returns are not indicative of future returns, because they're not. Everything goes in cycles, even the outperformance of QQQ. Okay? I hope you enjoyed this video. If you did, please smash the like button, subscribe to my channel, drop a comment if you disagree, and you have a wonderful, delicious night.